In this video, we will discuss closing entries, closing journal entries, that is. Now, for refresher, journal entries are the first book of entries. So, it is the book of original entry for all transactions in a business. This is the first place a transaction gets recorded, and it can be manual in a physical book, or it can be computerized for a company. At minimum, journal entries will show the date of the transaction, the account titles affected by the transaction, and the amounts of the transaction. And a journal entry will also show the amount of debit versus credit. And in a journal, transactions are recorded chronologically. Now, at the end of the accounting period, we've learned that there are certain accounts where balances of these accounts do not carry forward from one period to the next. So at the end of the accounting period, these accounts are closed, meaning we bring the account balance to zero. Closing accounts is the process of transformation from the temporary accounts, the accounts that will be closed at the end of each accounting period, to the retained earnings account. Since we do close temporary accounts, the beginning balance in the next period will always be zero for these accounts. And the temporary accounts we've learned about are revenue, expenses, and dividends. All three of these accounts will be closed at the end of every single accounting period. And their balances will be closed to retained earnings. Then we also know about permanent accounts, where balance of these accounts carry from one period to the next, and they're not closed. So looking at the balances in any of the permanent accounts, we will be seeing amounts from the beginning of time. So asset accounts and contra asset accounts are permanent accounts. Liability accounts are permanent accounts, and stockholder equity accounts are permanent accounts. So to close the temporary accounts, revenue, expenses, and dividends, we need to follow 3 steps. The first step is to close all revenue accounts to retained earnings. We will need to consider the dealer mnemonic, or the accounting rules describing the normal balance of the revenue account, because we'll want the amount of the revenue account to go into retained earnings at the normal balance. Meaning revenue is increased by credits, therefore the amount of revenue hits retained earnings as a credit. Step 2 will close all expense accounts to retained earnings. And we can do this in one or several entries. My preference is to see one entry, so retained earnings, and then list all the expenses as the credit. Again, the expenses will need to hit retained earnings at the normal balance of the expense accounts. We know that expenses are increased by debits. Therefore, the amount of these expense accounts will be hitting retained earnings as a debit. 2, retained earnings is debited for the amount of expenses. And the last step is to close the dividend accounts to retained earnings. Similar to expenses, dividends have a debit normal balance. As such, the amount of dividends will be debited to retained earnings when the account is closed. So let's look here at an example. It says prepare the closing entries for the temporary accounts as of December 31st, year 2 for Collins Brokerage Services, Inc. Now, to the left, we have an adjusted trial balance. So that means that all the adjusting entries have been accounted for. So the first step is to determine our temporary accounts. We just decided that they are revenue, expenses, and dividends. So our first step, we'll close the revenue accounts. Looking at our adjusted trial balance, there is only one revenue account. it is service revenue. And revenue again has a credit balance, therefore we will credit retained earnings for the amount of services revenue. The services revenue account now has a credit balance of $17,260. In order to close this account, we must debit it. So we have services revenue being debited for $17,260, and then that amount is going into retained earnings as a credit as the normal balance of services revenue account, $17,260. Next, we'll close all expense accounts to retained earnings. So we have several expense accounts. We have salaries expense with a debit balance of $10,300. We have supplies expense with a debit balance of $725. Other operating expenses with a balance of $1,900 debit, and then interest expense of a balance of $500 debit. Now, all of these accounts have a debit balance currently, so we must credit these accounts in order to close them. So that means we must debit retained earnings and credit all the expenses. So salaries expense, insurance expense, supplies expense, and other operating. Salaries were $10,300. Insurance was $500. Supplies was $725, and other operating expenses was $1,900. The total expenses being debited to retained earnings is $13,425. And so after that, we have balancing credit and debits into these accounts. Therefore, their balances are zero. Lastly, we'll close the dividends account. Dividends has a normal balance of debit, so there's $800 in there now. In order to get it out, we must credit the dividends account. So we'll credit dividends for $800, and our debit must be retained earnings because we are closing this account. And that amount is also $800.